Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today I'm going to be talking about the NASDAQ index and basically how it fell on its face yesterday on the reports of the CPI data, which alludes to the fact that inflation is not going down at the pace that many had expected. And what's really interesting with yesterday's report, September 13th, is the fact that we had a rally going into it because most people were under the assumption that this was the report where we start to see the downtrend, right? So there was a lot of excitement in the market like, hey, we might finally start to see this stuff tick down. Maybe it will change the Fed's outlook. None of those things happened. And when I say the NASDAQ fell off a cliff, you can see exactly here what that looks like. This is a 5-day chart. I was talking about the buildup. So you see the buildup here starting on September 9th. And I don't know what time that report was released, but as soon as the market opened, down she blew, right? All the way in. And today's September 14th, you're having a minor rebound, 0.57%. But if we go back to the article, NASDAQ Composite at one point was down 5.2% in a one-day period. Now, the S&P and the Dow were down as well, but NASDAQ is always going to get hit harder in these situations. And the reason that's the case is because with tech stocks, first of all, they typically have a higher valuation multiple than other things that you would see in consumer goods, for example. A lot of NASDAQ stocks are going to be well into the double digits on ratios like PE ratio and forward PE ratio. And when you compare that to something like the retail sector, where you have price to sales well under 2, you have forward PEs, maybe barely in the teens, the NASDAQ is always ripe to get a bunch of sell-offs when you have negative economic conditions. And the other thing that comes into play with NASDAQ composite stocks is the concept of innovation and how much money that costs. So when interest rates go up, or I should say when inflation goes up, not only do core goods used for innovation get more expensive, but then we see the Fed react with interest rates. That affects what businesses can purchase on their CapEx lines, right? So that they can build the facilities and the infrastructure that they need to continue innovation. So that's where you get a lot of that weight coming down on tech stocks specifically. But what we're going to do in this video is take a more holistic look or back up a little bit on the NASDAQ and talk about, is it still expensive? How much farther can it go? There's a lot of different opinions on this. I kind of fall into the camp that this is a buying opportunity, particularly for the long term. But there's plenty of opinions out there that say, pause and wait because it's going to go down a heck of a lot further. All right, now on one side of the coin, you have people like Michael Burry and Jeremy Grantham who are talking about an epic stock market crash and that it's currently underway. To be fair, this article was published on September 4th, but it goes to 5 people who are far along on the bear side. They are heavily bear. And it goes through this review of each person. Michael Burry diagnosed last year an unprecedented bubble in asset prices and warned it would culminate in the mother of all crashes. He hinted the meltdown is in full swing in a since-deleted tweet this week. All right, so here I am, just a regular guy on YouTube who invests for his family, and I have a completely different perspective than a bigwig like Michael Burry and the rest of these guys. Jeremy Grantham, he cautions that an epic super bubble across stocks, bonds, and housing was about to collapse, writing in a research note this week. So again, this is a September 4th article, but you can tell that these quotes are in the recent past, right? Well within September. This is not something that was projected, say, 3 years ago. These are all people piling on the bear train. All right, let's go down. We have Nouriel Roubini. Hopefully I said that correctly. He suggested during a recent webinar that the Fed might have to raise interest rates to 5% to rein in inflation, but he said a hike of that magnitude in the debt-ridden U.S. economy could cause stocks, bonds, housing, credit, private equity, and other markets to crash. Now, what's interesting about this particular person, the NYU Stern economist, whose nickname is Dr. Doom. So if your nickname is Dr. Doom, I think you probably position yourself on the bear side in a regular fashion. He argued the economy was poised to suffer a painful recession, which could drive stocks down by another 35%. So that's three big dogs there calling for the mother of all crashes to come through. Then you have Robert Kiyosaki, who, to be fair, generally hates the stock market, right? Similar to Burry, Kiyosaki sounded the alarm on the biggest bubble in world history last summer and said it would end with an equally historic meltdown. That crash is here, he tweeted this week. Millions will be wiped out. So this is back in the week of September 4th. Millions will be wiped out. This is going on now. The crash is here. So says Robert Kiyosaki. And we have Harry Dent. Harry Dent, a market historian and newsletter writer, warned investors that the recent bounce in stock prices would be followed by an even bigger decline. So when we talk about decline, and we go back a little bit, he says recent bounce. Again, that article was September 4th, so he's probably talking about this bounce here. He's definitely calling for this massive decline that we did actually happen to see yesterday when the inflation news came out. All right, so we have tons of well-respected opinions that are calling for huge crashes, 20%, 35%. From one of those experts of where this market's going to go. And we also know that the NASDAQ is much more volatile than the S&P or the Dow. So we can make the broad assumption that NASDAQ is going to probably get hit even worse than some of those more balanced funds. The S&P 500, for example, is less about technology and spread across energy and some other safer stocks, if you will. So if the NASDAQ is going to fall, let's just pretend it's going to fall another 20%, okay? Where does that put the valuations for the stocks that are within the NASDAQ? And this to me is really the key question, because if you break things down, year to date, we are down in the NASDAQ Composite, we're down 26%. All right. 1 year, you're down minus 22%. So if you bought conceivably a share of the index back on September 14th, you have since lost, September 14th of last year, you have since lost 22%. If you bought it on the first trading day of the new year, which looks like roughly January 2nd, you are down 26%. Now, how many people went all in on the first trading day of the year on the NASDAQ? I'm not sure. But if you would have waited, let's just say until the end of January on 125, you would have come in a lot better than the minus 26%. You'd still be down. It looks like it was 13.3 or so. Today we're at 11.7. Certainly much better than the 15.8 that we saw on the very first trading day. So it's all kind of a perspective of which day you purchased on, and perhaps more importantly, how much did you buy? Did you go from zero to buying the whole thing? Or did you pepper in a sort of dollar cost average? Or did you only buy on certain days when the market was red? So depending on how you approached it, your year-to-date minus 26%, for example, could be substantially less than this kind of headline number that you see on the websites. For myself now, I've bought QQQ and TQQQ, peppered it in since November even. And if you look at November, you were much higher in November. But I didn't buy everything in November. Okay, in fact, I think it was this pullback heading into December that I started buying a couple things here and there just in case everybody's fear was overblown. Now, that fear, at least back in winter and heading into, I guess it'd be February, that fear was well documented and it turned out to be very, very true. Good news for me is I did not stop regular investments. So I've had the opportunity to buy in a few shares here and there throughout the rest of this cycle, and it's getting harder and harder with increased cost to put money aside for savings. But you just have to be careful when somebody says minus 30%, minus 20%. In what context are they talking about? All right, so we're going to look at the valuation of NASDAQ stocks as they stand today and try to see, are they expensive? How much further could this thing really, really fall? And in order to do that, I do want to demonstrate, though, that the NASDAQ Composite is a market cap weighted index. Okay, so it's not just one share of Apple and one share of Facebook. So that's important to know, is that even though it's a composite, it is still market cap weighted. And you can see this. This is an information PDF from NASDAQ. I think it was published around July 1st, late June. It comes out quarterly that they redo this thing. But if you go down here and you look at securities by weight, similar to the Qs, you have Apple, Microsoft, Amazon, Tesla, and put these two Googles together. So one thing you're not worried about is a single stock outside of these top 10 anyway, a single stock like really just crashing the NASDAQ as a whole. With that market cap weighting, it has some balance. That being said, pretty safe to assume if this Apple, Microsoft, double, Google, and Tesla have poor performance and they go down 20%, for example, then yes, we are definitely going to have problems in the composite as a whole. So with that in mind, let's just see how close to the edge or how close to the overvalued range some of these top stocks are that are in the NASDAQ Composite. So one thing that I share on this channel all the time that I've done over here in Seeking Alpha Premium is I put together this simple QQQ holdings portfolio, not the same as the NASDAQ Composite, I know that, but the top holdings are really going to fall right within the composite range and have the most impact on the outlook and valuation as the composite, just like they do for the QQQ. The only difference is with the Qs, it's the top 100 stocks, and then it stops there, whereas the NASDAQ, I believe, has over 3,000 stocks in total. But again, market cap weighted, you're still going to have these big dogs swimming at the top. Real quick, before we jump into those valuation metrics, Seeking Alpha is having a monster sale right now, and I know you've seen me use this service on my channel for a long time. This is a really good time to check it out and see if you're interested. $99 for the whole year. There are plenty of services that charge $99 a month who, in my opinion, aren't 1% as good as what Seeking Alpha Premium provides. So if you're interested in that special offer, check out my affiliate link in the description, potentially support the channel. I really appreciate it. The other thing to keep in mind with this awesome sale is your credit card will not be charged right away. You get a free 7-day trial. So as long as you cancel prior to that 7 days, then you can really try out the platform, compare it with some of the stuff I share in my reviews and tutorials, see if it's a match for you. But one thing's for sure is this price is not going to last for very long. Okay, let's look at some of those valuations for the big dogs in the NASDAQ Composite. If you're following along on Seeking Alpha, this is going to be, your alphabet stock page, right? And you're going to go to valuation, and it's going to give you sort of an algorithmic view of their valuation. Keep in mind that this is going to be compared to the sector median. So in Google's case, it's not compared to the NASDAQ Composite. It's compared to the sector, which I believe they are in communication services. So I sort of ignore this big letter grade here and look down at the raw numbers, right? So if we go on Google, and with Google, we can actually use GAAP metrics. They report in GAAP metrics, and we talk about forward PE under GAAP measurements. And that's a projection, right? Just to be fair, that's a projection. If EPS numbers come down or they don't hit, then this number would go up. But at 2017 on forward PE, Google, 27% less than their 5-year average. You probably can't see that. This is the percentage difference to 5-year average for all of these metrics, okay? So Google's 5-year average, which goes all the way back, obviously, to 2017. If we look at their forward PE, and if you're going to make your decision based on that metric, and you ask yourself, is this stock cheap today compared to where it is traditionally? Well, yes. At least on forward PE, it's minus 27% cheaper. Let's pick off a couple other lines. Can go down here, price to sales, forward looking, 4.69. They don't have a comparable. Okay, they don't have a comparable for that one. But if we go trailing 12 months, 4.9 on price to sales, that's 25% cheaper than you've seen over the 5 years. And then price to cash flow, if we look forward on that, 13.6, that is 23% cheaper than Google's been over the past 5 years. So my question, even if these numbers don't actually come to fruition, right, these projected numbers, how much farther is Google going to fall before it's the greatest steal of all time? You could argue that you're making a good investment today, particularly for the long term. And if some of these soothsayers come in with their minus 20%, I don't see Google going down 20% based on these numbers. But if it did, you better be ready to buy it. All right, same thing with Apple. Now, Apple is interesting, okay? Apple is interesting because you have a couple different factors at play. Right now, as we'll see here in a second, we'll just scroll off to this 5-year average column. We'll go for P gap forward, 25-21. That is actually 12% higher for Apple. And Apple, if you've been following it, it is on a little bit of a run-up because it just had its technology day where it talked about the new services coming in. And it's actually kind of interesting that Apple is at this place because they have a decent amount of sharks in the water when you consider production challenges with what's going on in China. Also, the Chinese market is always at risk of closing for COVID concerns, which could affect sales. Apple is one, or at least the first one here, that I would say, not that it's horribly overvalued. How about cash flow looking forward? This is where it's getting a little expensive, 2036 versus 5-year average of 1814. That's plus 12%. So these numbers here are very, very similar, plus 12%. Again, if you just take this on 12%, it's not really going to work that way mathematically, but you might shave off another $15 or so from Apple before you start saying, should I add more? Is it a significant good deal? I don't think Apple's there, but the X factor, so the other thing going on with Apple is massive share buybacks, okay? And then anytime a new phone comes out or new watches, etc., then the long-term health of their service business basically gets a boost, right? As people continue to upgrade. It's a very interesting ecosystem. I would never bet against Apple. I used to, 2-3 years ago, prior to COVID, be like, man, how does this company command some of the multiples that they do when they don't really grow at a high percentage rate? And the bottom line is because they're just a money machine. And once people get sucked into that ecosystem, man, they actually just print money day after day across every user. All right, next up we have Amazon. And Amazon is in an interesting place because they had some additional costs affect their EPS line. And that could also be the case this quarter too. So their EPS is all goofed up, right? It's all goofed up. And if I actually, let me see if I can show you an example of what I'm talking about right here. All right, so fiscal period ending December 2022. The estimate for the year on EPS is 5 cents, okay, because of those costs. That is definitely disappointing. You got minus 98% growth on that line. Now, on the bright side, the bulk of this 5 cents, bad news related to it anyway, is in the past. And there's reason to believe that third quarter, certainly into fourth quarter, could be good for Amazon, depending on who you believe. All right. Needless to say, though, next year is pretty easy. 229 will smoke 5 cents all day. That'll bring forward PE if they keep on this path. Their forward PE will drop to 55.49. All right, so keep this in mind. 55.49 is the one that we're going to use. Because this chart is all messed up because of where that EPS landed for the year. So 55.49 on the forward PE ratio. The 5-year average, okay, 134.82 is the 5-year average on non-GAAP forward PE. The GAAP 5-year average is 175. So, you know, on that previous page, we talked about that once you get into the start of 2023, you have a forward PE of 55 projected. So yes, I would say that on that metric alone, Amazon looks good. Now, how about sales? All right. So price to sales, looking forward and looking back, it doesn't take a mathematical genius to see Amazon 30% off of trailing price to sales, minus 25% valuation on forward price to sales. So it does look pretty good. And even cash flow, which could be an issue in the short term for Amazon because they're paying off for a bunch of investment and infrastructure. But cash flow on the forward level, it is a little bit higher, or I should say it is a little bit lower than what we've seen in the past. So all good news. It was higher this year, which is not really surprising if you follow the company. But looking ahead to next year's projected numbers, it's coming right back down. All right, so I would say Amazon is a deal. Like all the other stocks on this page, you may not necessarily run out and buy everything all at once. But if Michael Burry's, greatest recession of all time happens, you'd have to kind of think about it based on the valuation today. All right, let's jump over to Nvidia, very popular stock. A lot of people freaking out on Nvidia's future. What's going to happen? Are they going to negative comp for the end of time? I personally don't think so, but it's been a pretty big discussion after some meh earnings reports over the past couple quarters. Now, Nvidia is straight up non-GAAP reporting. So that's sort of their default way that they report on PE. So we'll use that. 38 times projected into the future. 5-year average is 41.79, so minus 7%. And then if we go backwards, 48 was their 5-year average on non-GAAP PE looking backwards. That's down minus 37%. So not as big of a deal, I would say, as maybe Google or perhaps even Amazon. But yes, it is below the average on the PE level. Price to sales looking forward, 12 times as far as today's projection goes. That's 18% off their 5-year average. All right, and even for rear view mirror is minus 34%. Price to cash flow, looking forward, 43.82, that is a little bit higher. So the cash flow, a little bit higher. That doesn't surprise me because of how, on a 5-year scale, how quickly they saw such huge jumps in the need for their product line. But keep in mind that if you're just going to follow it on a projected cash flow basis, it could still be, 7 to 10% overvalued from here. With a company like Nvidia, though, and as it relates to NASDAQ Composite, if they did fall $13, $14, $15, I think you'd have to consider it with the understanding of a 3 to 5 year hold could pay off very handsomely. All right, how about PayPal? PayPal is a stock that I'm wildly underwater in. I believe my cost basis is 165, 68, something like that. And I've come to the realization with PayPal over the short term that I'm just going to hold it. For now, things will get better, and here's one of the reasons that I believe that. PayPal, like Nvidia, is a non-GAAP reporting company. So you've got a 24 on the forward non-GAAP P ratio. That's been about 39 over the past 5 years, okay? So that's a minus 40% on the 5-year average. Then if we go down and look at price to sales, 3.94, they actually don't have a forward projection on that. So let's just look backwards. 4.20, that is minus 51% of the 5-year average. And I can tell you that from a news perspective and a rollout perspective, PayPal, I mean, they're not going to set the world on fire with some of their releases, but they do have a bright future. So I do expect this number to go down. And then if you get into price to cash flow, and you haven't looked at this one, forward price to cash flow 19 times, basically. That's 32% off their 5-year average, which is absolutely incredible. And trailing 12 months, you're 56% off of what this one has traded for in the past. All right, guys, so there's 4 or 5 stocks and where they stand in terms of valuation today. And if we float back to our friend here, Harry Dent, and you remember I sort of did a little blurb about what each of these bears were writing. And what's interesting with Harry Dent is you kind of had this headline quote, right? Negative, of course. We had this first crash, tepid bounce, and now we'll have another one of the same magnitude, the market historian and newsletter writer said in a recent radio interview. Interestingly enough, though, as all good websites do, they lead with the negative when it comes to stocks, but he comes down here and he says, Dent touted the expected downturn as a chance for young people to invest at reasonable prices, generate robust returns, and save for retirement. He recommended investing in multifamily real estate and long-dated treasury bonds before asset prices crash. So that's before, right? If they do crash in the way that he's projecting, he's basically saying go out there and buy at reasonable prices, generate robust returns, and save for retirement. Guys, this is exactly why when we get all this negativity on the internet around the stock market and inflation and everything else, you just really have to close your ears. People think I'm absolutely nuts for buying into QQQ, even my experiment with TQQQ, which you can read about on the channel. Maybe I am nuts, right? And that's okay. It's my money. I'll worry about it. You don't have to. But I think the NASDAQ has some intriguing opportunities for the long term while we were in this current, bear cycle, if you want to call it. I'll say bear sentiment cycle more than I would be worried about the economy as a whole. But that's just my take. Now, before you go, don't forget to check out that Seeking Alpha Premium special offer while it's still going on. My affiliate link's in the description. But let me know which side you fall on. Are you with Michael Burry and his friends here on the epic market crash? Are you doing like I'm doing and zagging where everyone's zigging and just adding some QQQ and TQs slowly throughout this whole process? Let me know in the comments. Hope everybody's doing well. We'll see you on the next video.